Thanks everybody for joining us today. This is Dwight K. I'm one of the co-founders of Cove Capital Investments. Today we're going to be talking about Delaware Statutory Trust, industrial DSTs for 1031 exchange. So Delaware Statutory Trust offerings or investments, and specifically going into the industrial DST asset class for 1031 exchange investors. Not just 1031 exchange investors at Cove Capital Investments. We have a number of clients that have already participated in 1031s into DSTs, and now they're talking to us looking for opportunities to diversify outside of the stock market and get out of kind of the volatile, ups and downs of the stock markets and into something that is hopefully a little bit more secure and stable, such as a debt-free DST. So these are available for cash investors as well. Very quickly here, I've got a quick overview of what we're going to be talking about on today's webinar. First, we're going to be going over risks and disclosures. Always important to understand the potential pros and the potential cons of investing in real estate as well as Delaware statutory trust properties, so risk and disclosures. Second, we're going to be going into why industrial real estate as an asset class for 1031 exchange DST investors. So what are some of the trends and things that we need to understand about the industrial real estate asset class as investors? Number three, current Cove Capital industrial DST offerings. So we're going to be going into some of our current inventory. We've got a couple different offerings that we're going to be going over. Number four, available DST investments for 1031 exchange and direct cash investors. And then number five, an overview of Cove Capital Investments and our portfolio. So jumping right ahead here, risks and disclosures, bear with me. All DST properties shown are Regulation D, Rule 506C offerings. All offerings are subject to availability. There can be no assurance that any DST properties and offerings shown will be available for purchase. DST 1031 properties are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence, and or possessing an annual income of over $200,000 or $300,000 with a spouse and expecting the same or greater for the current year, as well as accredited entities, which are generally described as an entity owned entirely by accredited investors and or owning investments in excess of $5 million. Please check with your qualified CPA or attorney to determine if you are accredited yourself. This material is not to be considered tax or legal advice. Please speak with your own CPA and attorney for all tax and legal advice prior to considering an investment. The Internal Revenue Code, Section 1031, Section 1033, and Section 721 are complex tax codes. Therefore, you should consult your tax or legal professional for details regarding your situation. All real estate and DST properties contain risk. Please read the full private placement memorandum or PPM prior to considering an investment. Please do not invest in real estate or DST properties if you cannot afford to lose your entire principal amount invested. Potential cash flow, potential returns, and potential appreciation are never guaranteed and could be lower than anticipated and or be negative. And lastly, this material contains information that has been obtained from sources believed to be reliable. However, Cove Capital Investments, FedEx Capital, and their representatives do not guarantee the accuracy and validity of the information herein. Investors should perform their own investigations before considering any investment. Past performance does not guarantee or indicate the likelihood of future results. Diversification does not guarantee returns and does not protect against losses. Securities offered through FedEx Capital, LLC, member FINRA, and SIPC. Okay, jumping right into it. So why industrial real estate as an asset class for 1031 exchange DST investors? So when considering a DST, there's a number of different asset classes that an investor could consider to invest in. You've got multifamily, office, retail, student housing, you've got build for rent communities, you've got single tenant net lease, you've got industrial properties, hospitality or hotel, a number of different asset classes. And when we're looking at what types of properties to acquire at Cove Capital on behalf of our 1031 exchange investors and on behalf of ourselves, the co-founder of Cove Capital Investments, my partner Shay Lapin, he and I personally invest in each of our offerings. So when we're looking at what types of assets to buy, we're really trying to mitigate as much risk as possible. And there's certain asset classes that have higher potential risk from a general overview standpoint. And from what we've seen over the years, as we've participated in over $30 billion of DST investments, and there's also others that have been more resilient. And so obviously past performance does not guarantee future results, but it's something that we need to look at. And so why industrial? Why do we like industrial real estate? So first and foremost is rental rates, and the average asking rates in 2023 rose 20.6% year over year. So you've got large amounts of rental rates increasing year over year, so by almost 21%. And that's a function of, the market, the supply and demand imbalance. There's just a lot of increased demand for industrial real estate and not as much supply. Okay, and there is new supply coming online, but with the growth that we're going to be talking about shortly, that new supply has been absorbed well, and we've seen rental rates rising. So that really bodes well for the owners of industrial real estate, which is one of the reasons why we like to buy it at Cove Capital. So rental rates, average asking rose 20.6% year over year, 2023. Vacancies, so average vacancy nationwide, it's hovering around 3.8%. With many markets maintaining a sub 2% vacancy rate. So we consider that a very healthy market. Really anything that's 10% or less vacancy, we would consider relatively healthy. When you're looking at some of the other asset classes out there, you're seeing vacancy notching up 12, 15, 20% depending on the asset class. And we really like to see as low of a vacancy rate as possible, because that just shows, again, there's a lot of demand for that particular type of real estate. So nationwide, hovering at about 3.8% average vacancy, bodes really well for industrial property owners, in our opinion. Growth trends. So e-commerce, that's a huge growth trend, which we're going to go into a little bit more specifically on the next slide here and the next bullet point. But e-commerce, everybody knows the growth of e-commerce, the amount of people buying and shopping online today as compared to 10 years ago. It's staggering, with Amazon, with purchasing online, all the online retailers. You've got a huge amount of growth in e-commerce, which we'll get into shortly. Geopolitical fragmentation, which includes onshoring by U.S. corporations. Okay, so with everything going on in the world these days, U.S. corporations are wanting to limit their future global supply chain disruptions, as we all saw with the COVID virus and the months and years after COVID-19. We saw a lot of supply chain disruptions. So many U.S. corporations, they're wanting to onshore, right? Previously, the trend was offshoring. Take your manufacturing, your logistics, your distribution facilities, take them out of the United States for cheaper labor, for the ability to essentially have a much larger labor pool at lower pricing. And so at the end of the day, now it's back to the States, onshoring. And so that's fueling demand for U.S. industrial real estate space. So onshoring, global geopolitical fragmentation, and e-commerce, those are growing trends for industrial real estate. Number 4, e-commerce. So the revenue in the e-commerce market in the US, it was forecasted to continuously increase between 2023 and 2027 by in total about $551 billion. So that's a 54% forecasted increase. And this is by Statista.com. We've got the source down here at the bottom of the screen here. So according to this forecast, in 2027, the revenue will have increased for the 4th consecutive year to 1.6 trillion US dollars. So e-commerce is revolutionizing industrial real estate. The need and demand for logistics and warehouse space is growing in a very, very large way. So that's another reason why we like to buy industrial assets with long-term net leases, with large corporate tenants on the leases, because of the supply and demand imbalance, and then the trends that we're seeing with e-commerce. And then number 5, this is very interesting. We've done at Cove Capital, I think it's 60 plus DST offerings that we've put out for our investors, roughly around anywhere between $500 and $600 million in capitalized assets for our DST investors. And our portfolio held up relatively well during the pandemic, during COVID-19. And that's because most of our tenants were essential businesses. And that's another reason why we like industrial, because many industrial tenants, they were deemed essential businesses during the COVID-19 pandemic, and therefore remained open and paying rent to DST investors each and every month. And obviously past performance does not guarantee future results, but being that the industrial asset class has some pretty favorable statistics behind it, some pretty favorable growth trends behind it. You've got the e-commerce boom behind it. And then on top of that, these tenants were deemed essential businesses. We feel that this asset class makes a lot of sense for many investors and should be considered when thinking about utilizing the Delaware Statutory Trust for 1031 exchange or direct cash investment. So this next slide here goes into the e-commerce trend that we were talking about just now. Shows from 2017 all the way through 2027, and the revenue of the e-commerce industry in billions. So in 2017, we were just about $400 billion of revenue in the e-commerce industry here in the United States. Now in 2023, we're looking at almost more than doubling, over a 50% increase to $1 trillion. And then between 2023 and 2027, the experts are predicting that it's going to be at over $1.5 trillion. So massive growth in the e-commerce space. And in the United States, what that means is more need for logistics, warehouse, industrial facilities. And we think as a landlord, that's a pretty good place to be. So this kind of chart really shows the reason why. So now that we know why industrial real estate as an asset class for a Delaware Statutory Trust investor, let's jump into one of our current offerings. We've got 3 different offerings we're going to go over today. The first being the Cove Net Lease Distribution 55 DST. So we've already closed on this asset. It's in Gunnison, Colorado. It's a brand new construction FedEx ground industrial distribution facility. It's a build-to-suit for FedEx ground. So it's got a 10-year term with 2 5-year renewal options. It's considered an essential location for FedEx ground. The building is about 38,000 square feet. Like we were saying earlier, a lot of industrial tenants tend to be essential businesses. Case in point, FedEx ground remained open and paying rent throughout the entire COVID-19 pandemic. We've owned many, many different FedEx grounds, FedExes, FedEx freights throughout the history of Cove Capital. I think the number is somewhere around 12 to 20 different FedEx industrial buildings throughout the country that we've owned and operate now, or maybe we've sold on behalf of our investors, but they're an essential business. So we like that about FedEx ground. And FedEx ground, it is the fastest growing and most profitable subsidiary of FedEx Corporation, which FedEx Corporation is an investment grade tenant, and they're traded on the New York Stock Exchange under the ticker FDX. So Cove Net Lease Distribution 55 DST, it's in Gunnison, Colorado. So some of the reasons why we like it: 100% leased and guaranteed by FedEx ground. Again, the fastest growing, most profitable subsidiary of FedEx Corp. 22.7 billion fiscal year revenue. So multi-billion-dollar revenue corporation with 225,000 team members, and over 12 million packages are delivered every day throughout the FedEx ground system. So we really like that. And that's, again, being fueled by the e-commerce distribution wave. Number 2, it's an essential location for FedEx ground. So Gunnison is a town in western Colorado. It's a college town, and it's located in the Crested Butte and National Ski and Summer Resort area. So the Crested Butte area of Colorado, you've got a huge amount of tourism and adventure travel in Gunnison, in this area, due to not just the skiing and the snowboarding and all the winter sports, but even more so in the summer, with the summer sports, with the fishing, with the kayaking, the whitewater rafting, etc. You've got a lot of people visiting this part of western Colorado. So we like the asset because it's a build-to-suit for FedEx ground, and that it's a highly sought after western United States industrial net lease asset. So we feel that at the end of the day, what we've done on this offering is put together a situation that mitigates risk for our investors, okay? Being that it's a very large corporate tenant with many billions of dollars of annual revenue, FedEx Ground, a brand new construction property with a long-term lease. It's got a brand new 10-year lease, okay? And then lastly, it's a debt-free offering. There's no mortgage on this building. Okay, so investors have no risk of lender foreclosure. Even if FedEx Ground were to go bankrupt, out of business, which we obviously don't believe that's going to happen. They've been around for many, many years, $22 billion of revenue, and we think they're going to be around for a long time. Again, past performance does not guarantee future results, and things do happen to large public companies. However, we feel strongly that their business model is intact, and that a nice long-term lease being debt-free makes a lot of sense for us personally as investors in the offering, as well as for our investors. And then lastly, again, a build-to-suit construction for FedEx Ground, so long-term net lease with minimal landlord responsibilities. And the triple nets, or the net leases, are a type of lease whereby instead of the landlord being responsible for maintenance, taxes, and insurance, and that's how a apartment is, or a lot of office buildings are, whereby the landlord, the owner of the building, is responsible for the maintenance, the taxes, and the insurance, and what the tenant pays is a gross amount. Okay, whereby the net lease is the tenant and not the landlord, but the tenant is responsible for the majority of, if not all, of the maintenance, taxes, and insurance at the property. So we like long-term net leases for our investor base. And then lastly, it's a purpose-built specific location for FedEx Ground, and it's an institutional quality construction. So again, FedEx Ground wrapping up this offering in Gunnison, Colorado. COVID-resistant essential retailer, 65,000 FedEx Ground team members, 600 FedEx Ground operating facilities, and FedEx Ground revenue increased by 34% in 2021. So again, that e-commerce shift, which was really accelerated during the COVID-19 pandemic, where so many people that weren't shopping online all of a sudden started shopping online out of necessity. Okay, so they had a large amount of revenue growth. So next is our Cove Net Lease Distribution 64 DST. This again is an industrial distribution warehouse operated with Pepsi. It's a debt-free DST in Frankfort, New York, new construction, and it has a 721 exchange exit potential. Everything that we do at Cove Capital Investments has a 721 exchange exit potential, where we have the potential for an exit. We could sell to a third party, okay, an unaffiliated third party buyer that would come in, and we've done that a number of times on behalf of our investors. It's called full cycle, where we put together an offering, investors 1031 exchange or invest into that building, and we own and operate that building for a period of time, typically a number of years. And then from there, we sell the building to a third party, okay, an unrelated third party buyer. We list the building, market the building, go through a whole, call for offers and bidding process. And from there, select a buyer who goes through their analysis and diligence on the property and then closes on the asset. And then from there, we're distributing proceeds to our investors. So investors get to do another 1031 exchange if they want, or they get to cash out and pay the taxes if they want to do that. It's up to them. We also have this 721 exchange exit potential, where we'll be able to call these properties into a REIT, where our DST investors will be able to contribute their DST interest to the operating partnership of the REIT on a tax deferred basis. So that's the 721 exchange. It's very similar to a 1031 exchange. So they'll be able to contribute it on a tax deferred basis. And the reason why people would do that is because they're able to go from one building to a portfolio of buildings. Okay, so that's the exit potential. We never do any one particular offering based solely on the 721 exchange. We want to have options. We want to, look at the real estate and make sure that we feel comfortable that it stands alone on its own. But the 721 exchange is a nice exit potential that we have on this offering. So again, it's debt-free. It's a new construction building, 61,000 square feet, industrial distribution facility, 100% occupied, 0% offering loan to value. So we've got no risk of our lender foreclosure. It's brand new construction. We bought it directly from the developer. It's got a long-term 10-year lease with that 721 exchange exit potential. So this again is in Frankfort, New York, and Pepsi. Everybody knows Pepsi. They're enjoyed by consumers more than 1 billion times a day in more than 200 countries and territories around the world. And PepsiCo generated $79 billion of net revenue in 2021. So we all, know and shop and purchase these brands below here: Frito-Lay, the Pepsi products. You've got Aquafina, Doritos, Gatorade, and over 500 other brands. So Pepsi, we feel very strongly about them. We like that they're an essential tenant. We like the long-term 10-year lease, and we like the industrial asset class. And then on top of that, again, with DSTs, with real estate, there's never any guarantees for income or appreciation, never any guarantees that your tenant is going to be able to pay rent. I mean, we saw that during COVID-19. There was a lot of commercial landlords that had non-essential business tenants in their properties that couldn't operate their business, so stop paying rent. Okay, so there's never any guarantees for rental income or appreciation in real estate or in DST investments. So you have to be very careful in selecting your tenants and feel comfortable with their ability to continue to perform and operate no matter what situation comes. And on top of that, we want to make sure that we put together a situation where if the worst case scenario happens, well, what if the tenant, PepsiCo or FedEx Ground or another one of these large corporate tenants were to go out of business? Well, being that they're debt free, we don't have the risk of a lender foreclosure. Okay, there's been a number of different times where very, very large real estate owners and operators, the best and the brightest minds in the world that buy real estate on behalf of institutions, maybe on behalf of REITs or even DSTs, where they've been foreclosed on by lenders, okay? And investors have gotten completely wiped out and lost all their equity. Well, on those properties that they lost to the bank, it's not that the properties were necessarily bad, but something happened. There was a disruption to the rental income stream, and therefore the lender still had to get paid. The lender's mortgage payment was still due every month, but if there's a disruption to the lease payments or the rental income stream, you're looking at a potential foreclosure. And so it's not that those were bad operators or bad institutions. These are some of the best and the brightest minds in real estate in the world, but it was the debt, it was the financing they put on the properties that got them into trouble. So at Cove Capital, the vast majority of our properties in our portfolio, I think out of 80 plus properties that we have in our portfolio, I think 2 of them have loans on them. Everything else is free and clear. And the 2 that have loans, that was by design. We put them together that way. Everything else, though, is free and clear. And that was also by design. We're very, very risk averse at Cove Capital, and real estate and DSTs are already risky investments in general, right? Because there's no guarantees for upside. There's no guarantees for rental income. It's real estate. And so we want to mitigate the risk as much as possible. And so that's why that one we put together again as being a debt-free asset. The next one is in Richlands, Virginia, and this is the Cove Net Lease Distribution 66 DST. So this is a property that we actually have under contract right now, and we're moving to close on it. So the property, it's a long-term net lease. We've got a 10-year lease. It's a brand new construction that we bought from the developer. And that's the thing with Cove Capital. We've purchased 80 plus buildings with $500, $600 million of assets in our portfolio. We're a cash buyer. Sellers of these types of assets really like us, especially developers, especially owner operators that have financing. They might be a developer with a construction loan, a floating rate debt, or a seller that has a loan coming due that they originated 5, 7, 10 years ago when they bought the property. Well, Cove Capital can step in a uncertain economic environment, in a rising interest rate environment, and offer on these buildings. And because of our track record of closing, because of our debt-free nature, we'll oftentimes get awarded a property by a seller at a lower price than the other buyer out there, because the other buyer has to get financing. And in today's market, with rates rising, it's very difficult to get financing in today's market. So the surety of closing is something that a seller is willing to sell their property for less than the other guy would buy because we have the surety of closing at Cove Capital. So this is the same situation as I just described. This seller was a developer. We've purchased from them many times. They started developing this property a number of years ago, and the tide changes, and all of a sudden there's not as many buyers in the market that can close on an asset like this. And so that's something that's really been beneficial for us at Cove Capital as well as for our investors. So a couple highlights: it's an all-cash, debt-free, zero leverage DST offering, and again works for 1031 exchange and direct cash investors. It's a brand new construction 2023 construction asset, functional industrial. It's a recessionary resistant tenant, corporate backed net lease. PepsiCo global is on the lease here. You've got COVID-19. It's a pandemic resistant essential business tenant again. So there's a lot of trends that we like to follow and kind of play within at Cove Capital, and you kind of see them here. Long-term net leases. We also have some multifamily, but we like the debt-free strategy. The debt-free strategy, we believe, really mitigates risk, especially the catastrophic risk of a lender foreclosure. We like recessionary resistant tenants, tenants that did well through the GFC and great financial crisis, 2009 and 10. Okay, we like pandemic resistant tenants, tenants that did well and were essential in COVID-19. We like corporate backed leases. We don't buy any franchisee type stuff. And so there's some trends that we like to follow here, and they've served well for us personally as investors in the properties, as well as our outside clients that have invested over the years. So a lot of these properties look the same. They're we think they're exciting, but to others they might be boring because you don't have giant upside potential. You don't have all the projections for IRRs and levering up and looking to hit home runs. That's not what we're trying to do here. Okay, at Cove Capital, we're trying to provide one, protection of principal, which there's no guarantees for protection of principal. You could lose all your money investing in DSTs. And so that's why we want to be very risk averse, be debt free. So number one, our goal of protection of principal. Number two, provide a predictable, durable income stream. There's no guarantees for rent or distributions in real estate or DSTs. But when we're looking at this type of quality of tenant with multiple billions of dollars of annual revenue, essential businesses, recessionary resistant businesses, we feel confident that we're going to be able to provide that predictable, durable income stream. Obviously, again, we don't guarantee it, and that's why we have the risk factors. We encourage you, read the private placement memorandum, discuss it with your advisors, discuss it with your attorney, your CPA, discuss it with us. We'll walk you through the potential pros and cons, okay? So, and then number three, some modest appreciation, right? So protection of principal, predictable, durable income stream, and some modest appreciation when we sell it. Again, we're not looking for home run. We could have done that on a lot of our properties, which it's funny, a handful of our offerings that we've taken full cycle, we've seen comparable returns to other DST sponsors' leveraged offerings, okay? So we've actually done, in our opinion, very well. And again, doesn't mean that we're going to do well in the future. There's no guarantees for that. But being debt-free, it does hamper your returns, right? Your upside potential can be much higher if you're leveraging your equity. And that's why so many DST sponsors and real estate investors and sponsors and institutions, they love debt. They love to lever up. They love to enhance and juice cash flow, juice potential returns, which is all fine and dandy and all is great until it's not, until something goes wrong at the property level or in the economy or with your financing structure. And next thing you know, you're having a lender cash flow sweep, or you might have, foreclosure issues and your equity gets wiped out. And so we're not looking for home runs. We're looking for some modest appreciation. Okay. And then next, corporate backed net lease. Again, COVID-19 pandemic resistant essential business tenant. We have the 721 exchange roll up as a potential exit on this one as well. And this property, it's what we call a product exchange center, industrial facility for Frito-Lay and PepsiCo. So quick overview here. Frito-Lay is a market leader of snacks nationwide and owned by PepsiCo. Frito-Lay continues to outperform their competitors throughout the brands of Lay's, Doritos, Fritos, Cheetos, Tostitos, Sun Chips, Ruffles, and many more. And in 2021, this is what we really like here. Frito-Lay accounted for 25% of PepsiCo's almost $80 billion of revenue, and for 44% of their $11.4 billion of operating profit. So we really like that. It's this segment of PepsiCo Global, Frito-Lay, is vital to their overall performance for their shareholders. So we like being the landlord to this tenant. We like their business model and all the things that I mentioned already about it. So built in 2023, you've got abundant yard space. It has 5 docks, abundant yard space for truck loading and parking. It's a highly efficient distribution hub and maintains the ability to further expand the facility with additional square footage in the future. So we like that also because at the end of the day, if Frito-Lay, PepsiCo Global Real Estate, they wanted to expand this property, we have the space to be able to do that. And from there, there's a little bit of upside potential, no guarantees, but if that were to happen, we build out the rest of the space and they increase their rent, and that's a potential exit strategy right there for our investors. So no guarantee, but it's a long-term lease. It has annual rental increases. PepsiCo Global Real Estate Inc. has signed the lease, the 10-year industrial net lease in 2023, with 2% annual rental increases, which we believe allows a strong potential hedge against inflation. And then lastly, it's a strategic location. So this Frito-Lay facility is located strategically adjacent to Highway 460, and that runs from Norfolk, Virginia to Lexington, Kentucky. And it allows transportation within about a 4-hour commute between Charlotte, North Carolina, Knoxville, Tennessee, Lexington, Kentucky, and Charleston, West Virginia. So it's a essential location for them. So those are the 3 offerings we're going to talk about. Quickly, I'm going to jump into Cove Capital. We're different. We're debt-free. This definitely is a contrarian approach to most real estate investors out there. And we did this because a lot of our clients that were coming to us for 1031 exchange DSTs over the years had already paid off their mortgages, and they didn't want to take on more debt. But most of the DST sponsors, 90% plus of them, only around 90% plus or so of them, only did leveraged offerings. And so if an investor wanted to have the passive nature of a DST and not have to manage and be able to diversify, that investor would have to go into a property that had a loan on it, which increases risk. And so we set out to put together offerings at Cove Capital that remove that risk, remove the risk of the loan. And so we do believe this strategy is highly prudent considering the recent pandemic. We saw that it worked really well for us, considering the condition of the US economy and the current state of geopolitical global affairs. So this is a brief snapshot of our portfolio. Just note that investors in this offering or any of these offerings will not have any ownership interest in the properties represented above. These are other programs. We've got about 1.9 million square feet of real estate that we've sponsored and under management, 452 million in sponsored transactions. That's upwards between 500 and 600 million now. I don't know the exact number off the top of my head. We've got 81 properties in the Cove portfolio that we own and operate on behalf of our investors. And the Cove team consists of our asset management team, our accounting team, our property management team, our in-house counsel team, multiple attorneys and paralegals on staff here. We have our CFO and the accounting team, as I mentioned, as well as our acquisitions and dispositions team, and a handful of other support and operational staff. So the Cove portfolio or Cove Capital team, it really is a fully integrated real estate team, A to Z, to acquire, operate, and dispose of and sell when we believe the time is right, these various properties. So our tenant roster, we own properties like I just showed all over the country, and essentially, along with, industrial assets with these large distribution facilities or distribution tenants, e-commerce kind of tenants and shipping logistics tenants. We also have a number of single tenant net lease retail that are, essential businesses as well, whether it be fast food, coffee, auto parts. We have medical tenants. We have pharmacy tenants that, rural lifestyle supply tenants like Tractor Supply. these properties, and also dollar stores, these properties, pretty much every single one of them was deemed an essential business. And so they were able to stay open and continue to pay rent throughout the COVID-19 pandemic. And it was really interesting seeing these types of properties perform through the great financial crisis, and at the same time seeing senior care and hotels and student housing and various other asset classes that just got decimated by the financial crisis. We were able to see, hey, there's a trend here. These long-term leases, these types of properties tend to perform well during a recession. Well, fast forward, that same strategy ended up going exactly hand in hand with the pandemic and an essential business. So our strategy that we were deploying over the years for Cove Capital of recessionary resistant tenants translated and transferred very well for us during the COVID-19 pandemic, with these tenants still paying rent to us each and every month. So essentially, we're a landlord to some of the largest, strongest companies in the world. So debt-free investments, why debt-free? A lot of investors, all they know is debt when they buy real estate. And it's because there's really not a lot of options for debt-free, and Cove Capital is changing that. I'm going to go through these quickly, but one, no refinancing risk. Okay, that's a big deal. If your loan matures, there's about $3.5 or $4 trillion of commercial real estate debt that's coming due by 2025, just over the next couple of years. And that's going to be very difficult for a lot of those owners to refinance in today's higher rate environment. Okay, so there's going to be some bloodletting, we believe, and that's, for us, that's an opportunity to go out and buy some high quality assets. Okay, but for owners that have good properties but they put debt on them that isn't so good, it's not going to be the greatest situation for them. So no refinancing risk when you're debt free. Number two, very important, flexibility to hold through any potential market downturns, credit crunches, recessions, and or depressions. We don't ever want to be forced to sell. Those investors that had 10-year loans in 2014, they did a 10-year loan, maybe a CMBS loan or bank debt or life company, whatever it was. That 10 years is now over, and it's now 2024 next year. Okay, and so it's really not the best time to be a seller of real estate. Some situations, yes, it can make sense to sell, but right now we're more on the buy side. We're looking for opportunities. And so when you have a loan coming due next year or the year after, you're selling into potentially a down market. And that's something that if you're debt free, you're never forced to have to sell into a down market. Number three, no cross-collateralized loan risk that's found in certain leveraged DST and real estate investments. A lot of DSTs that are portfolios where they might have 3, 5, 10, 20 different properties in one portfolio and one DST. The real estate can potentially make sense, but the problem is they might have a 50 or 60% loan to value, and there's one loan on all 15 properties. And so the loan is cross-collateralized amongst all the properties. If one of the properties, something happens, the lender could force a cash flow sweep of the entire portfolio. Even though 14 out of the 15 properties are doing great, the lender might have the authority, you have to read the loan docs, to force a cash flow sweep on the entire portfolio. And that's called cross-collateralized loan. We even saw years ago, there was a major sponsor that runs a public REIT now. They had a portfolio in a DST of steakhouses, and it was, not a bad portfolio. It was 8 or 9 steakhouses, large national chain. Everybody would know the name of them, but that company went bankrupt. I think it was during the Great Financial Crisis in 2009 or 10. The company went bankrupt, and because that DST had a loan on it, when it went bankrupt, the lender foreclosed on the entire portfolio. Those investors lost all their equity. If it had been a debt-free portfolio, they would have had to re-tenant, they would have put a new tenant in there, and hopefully resume cash flow to the investors. But because it had a loan on it, they weren't able to do that. Where with our portfolio, if any of our tenants go bankrupt, that's not ideal. We're not hoping for that. That's why we choose some of the largest tenants that there are. We like investment grade tenants, recessionary resistant, pandemic resistant, et cetera. But if one of them did go bankrupt, that would mean that distributions to those investors would stop until we found a replacement tenant. And that might be 6 months, it might be a year, it might be 3 years, it might be 4 years. no knowing how long it would take to re-tenant that building. Okay, we've got a staff that's very, very focused when we do have leasing activity in our multifamily space or in our multi-tenant shopping center, multi-tenant industrial space. So we believe that we've got the team to be able to do that, but ultimately we wouldn't have a lender that required debt service to be paid every month. Okay, and that's because we're debt free. So if one of our major tenants goes bankrupt, yes, distributions stop to the investors for the time being, but we're not foreclosed on. So that's something that's really, really unique about debt-free DSTs as opposed to DSTs with leverage on them. And you as an investor need to understand and ask yourself, am I willing to be foreclosed on? Am I willing to lose all my principal in this DST if something doesn't work out with the loan? If you're not able to bear that risk, we highly encourage you, do not invest in DSTs that have debt. Okay, stick with debt-free DSTs to remove that potential risk. So you've got no cash flow sweep as found in certain properties with debt. Oftentimes, all cash debt-free real estate investments can have a higher projected cash flow than leveraged real estate investments due to there being no monthly debt service that needs to be paid to a lender. Okay, so especially with today's rate environment, rates going up, cash flow projected to investors on leveraged DST investments is lower oftentimes than the projected cash flow on debt-free DST investments. So very interesting time there. Number 6, it allows investors to protect themselves from the financial catastrophe of a complete loss of their principal due to a lender foreclosure. No balloon mortgage maturity, which is typically found in most leveraged properties. Again, you purchase your property in 2013 with a 10-year loan, maybe CMBS or life company debt. Well, now it's 2023, the loan's coming due next month. Okay, that's a balloon mortgage. Okay, so that's a major risk that investors that are investing in leveraged DSTs or any other type of real estate that has debt on it have the risk of. And then lastly, no lender prepayment penalties, defeasance costs, and or yield maintenance. So that's the end of our webinar today. Thanks so much for joining us. Again, feel free, reach out to us. We're happy to provide for you the private placement memorandums for accredited clients. These offerings that we went over today, again, the Regulation D Rule 506C offerings. We'll provide you the private placement memorandum. We'll walk you through the potential pros and the potential cons, help you understand the risk factors of investing. And if you'd like more information, just visit www.covecapitalinvestments.com. Email us at info@covecapitalinvestments.com or call 1-877-899-1315. We'll be happy to help you out in your situation. So thanks everybody for joining us today. Have a wonderful rest of your day.